Hello, hello. Welcome to the Grandma's Wealth Wisdom channel on YouTube. I'm Amanda Neely. So glad that you're here to join me, and Brandon should be here sometime soon, and our guest and friend, Sarry. We're so excited about our conversation today. We're going to get totally nerdy about how policy loans work. Now, if you're not familiar, there's a thing called bank on yourself or infinite banking, where you use a high cash value, dividend paying whole life insurance policy that builds a cash value that you can use when you want and how you want it. And you access it typically by a policy loan. There's Brandon. We're just welcoming people, getting started here. I need to make sure that people can see me. So get comfortable, Brandon.
I'm running a little late.
Yeah, all good. So we're going to get into the nitty gritty of how those policy loans work and why you'd want to put your money into a life insurance policy and then borrow against your cash value from the general fund and pay yourself back on schedule, in the kind of idea of being a good banker, is what they call it, and what that could mean for your future. And we got 2 case studies we're going to go through with that. Anything else we should say by way of introduction?
I missed the first little intro part, but I think you probably did a great job. As you join in, we want this to be interactive. So I might ask questions. If you guys have questions, put it in the chat and let us know. We will put it on the screen. We want this to be a place where you guys can ask us. I don't know. Amanda can see all that. I can't, I don't think.
Yeah, I'm in charge of the comments today. So if you're commenting on Facebook or YouTube, I will see it. I'll make sure we get to it. I think I should also say that Sarry, Brandon, myself, we're going to be speaking from personal experience as well. This isn't just something we do for clients. This is something we do ourselves. So we might add some of our own experience of what it's been like taking policy loans and what it looks like to pay those back and why we're doing it too.
Yep. So, and while you're here, don't forget, hit the like button, share the video, and subscribe if you have not already. Of course, people who are watching have already subscribed, I know. So.
I know, yeah. Okay, Sarry, I think you're up with the first example. Set it up for us before you actually share your screen and dive into the Excel sheet.
Yeah, for sure. Thanks, guys, for having me on. I appreciate it.
Yeah, thank you for being here.
Thank you. So I'm going to share, let's see, share screen. Okay, can you guys see my screen?
Almost. Yes, now we can.
And
you see the Excel sheet.
The audience, if you can't see the screen, let us know, because we can always make it where we are off the screen, and you can do that too. But if there's any kind of like, I can't see it, yeah, totally let us know.
Okay. So what I'm doing here, guys, is I set up, so there's a lot of different ways, as the audience probably knows, there's a lot of different ways to set up these policies, right? There's policies where you could pay into them like monthly premiums. There are policies where you could do like single premium cases. I just chose a single premium case here as an example. This is a client putting in $400,000, like a lump sum payment, and then having no more payments after that. So there's no more contributions or payments after this. It's just the lump sum here. It doesn't have to be 400,000. I'm just using this example here. And then, of course, what happens is 2 things happen, right? We have the cash value here. We also have the death benefit here. Now, in this example, the client is going to borrow up to 90%, the maximum, in year 1. So he's going to borrow $327,000 here as a loan from the insurance company. Now, when he does that, a couple things happen. So we're going to go over here to this loan calculator.
And can you go a little slower? So first, he had 400,000. Where did that 400,000 come?
So this here is a real estate,
so just a general person.
Yeah. So this here is a real estate investor.
A real estate investor.
He sold one of it. Yeah. and he sold one of his properties. He had like $400,000 in cash, and he was kind of debating if he should kind of just roll that into another property or put it into like a CD or a money market or just leave it in a bank account. So this was one of the options, is to do a single premium whole life policy. And the reason why is because not only does it fund the life insurance here with one payment, almost more than 3 times or more than 4 times what he put into in life insurance, but also the cash value component too. Here, the cash value grows pretty much from dividends and interest every year, and it compounds, even when he takes out the loan. So even when he borrows, in year 1, he borrows $327,000, and he's going to use this for real estate as well. This lump sum right here, 327, he's going to borrow. And pretty much he's going to, like in this example here, we'll finance it over 8 years. It doesn't have to be,
And I'll say that again, his money is still growing, even though he accessed it.
Exactly, yes. And the reason why is because he's not deducting from the cash value here. He's borrowing from the insurance company's general funds, leveraging his cash value. So this way he can kind of do 2 things now. He could keep growing his cash, and he could take advantage of real estate as a cash buyer, essentially, because he's going to take this 327 now and then go buy, one property or more than one property, depending on the market, depending on what type of property he buys. But he's pretty much like a cash buyer now. He's going to become his own mortgage, where he can finance his own property in-house, finance it. He can control when he pays it back. And then also he can control, using this calculator here, control how much he pays back and what time. So for example, let's say he takes out $327,000.
Can you zoom in a little bit on this one?
Oh, yeah, sure. So he borrows 327, and let's say that he's gonna pay let's just do like 4,200 a month. Doesn't have to, these numbers aren't like solid. You don't have to follow these exact numbers. Just kind of gives you an idea of what happens when you do it this way. So pretty much he's gonna borrow 327, finance the property. Now he's gonna become his own mortgage, where he's paying himself back 4,200 a month, and for 8 years. So this lasts about 7.5 years. And he would have paid a total back to the insurance company in 7.5 years. He would have paid a total of the 327, the original principal borrowed, plus interest, of course, because he's borrowing from the insurance company's general funds. He has to pay the insurance company interest. He would have paid them $54,000 in interest to the insurance company over 7.5 years. Now,
that's a lot of interest.
You're right. That's a lot of interest. You're right. But what happened when he did that is his policy kept growing and kept compounding as if he had never touched it. Actually, it grew by, let's go over here. So 7.5 years later, so 1, 2, 3, 4, 5, 6, 7, pretty much between 483 and 500. Let's just round to about maybe 490. His cash value 7.5 years later would be around 490. And I got that from pretty much calculating 7.5 years afterwards. So this is the gains right here. So pretty much his policy. Now let me ask you guys a question. How much did his policy grow by during that 7.5 period?
About 90,000 if it's at 490,000 at that point.
90,000. And then how much did he pay in interest?
54,000.
Yep. So pretty much he was able to finance a property, pay himself back, and have an arbitrage, a gain in interest earned of about almost $40,000 just in earning from the policy. Now, let's say he skipped all of this and he just bought that property for cash for 327. He would no longer be able to earn interest on that money. So this way, this solution kind of met him between both ways in the sense that he was able to take advantage of cash deals while also having the ability to earn interest on his capital, even when he was using it.
Cool. So basically, he paid 54,000 to make 90,000, and his net was about, what would that be? 36,000.
Yes.
And the story doesn't end there, right? Oh, did we lose your sound, Sarry?
Oh, sorry. Okay. And also look at the life insurance, how much the life insurance grew by too. It kept growing without any more dollars too. And then he can keep doing this over and over again. He doesn't stop here. He can pay that money back now and then take out a loan up to 90% of this column here, whatever's in this column, all over again, and keep doing the cycle over and over again.
Yeah. Cool.
Well,
now,
and I think, again, the power of the death benefit is really, people tend to, like, I don't know, say, hey, it's not a big deal. But let's say he passed away between now and then. If he used cash, he would have lost the, he wouldn't have that 1 million or however much it was death benefit.
Yep.
Exactly.
And, yep. Yeah. And like the cash value is nothing to gawk at either. Like some people might be like, yeah, making 36,000 over 8 years. That's not that much to make, but you have to factor in he was also making money on that property through the appreciation of that property. And that just goes on top of it. I wonder for this guy, where would he get the $4,200 per month to pay back the policy loan?
Yeah, good question. So it doesn't have to be 4,200 a month. He could do all of this, paying different amounts. If, like, for example, he could pay it back in lump sums. But let's say he had the property rented out. Let's say it was more than one property and he had them both rented out. That could be a source of paying the loan back. Also from different places, he would have cash flow. So it kind of depends on, that's something we would consider, right? Where is his cash flow coming from and how much, to be able to determine the loan calculator. But it could be, for example, he could pay, 100,000 a year back over 3.5 years, or however it's structured. So it's not, that's another advantage of using this as opposed to using other forms of financing, is that you have the ability to control the frequency. You could pay monthly, annually, larger amounts. He could even do this over 15 years if he wanted to.
Yeah, I think that's really powerful too, for sure.
Yeah, another thing too. Oh, sorry.
Yep. Go ahead.
Okay. I wanted to see the screen a little closer up. I'm sure the audience would want to see, like, hey, let me see those numbers again, or play around with the numbers, maybe making it a smaller amount or something. I don't know. We're going through another case too, I think.
I've got another case study. I don't know how many 41-year-olds have $400,000 or say 29-year-olds. So I've got an example coming up. Stick with us, of somebody who starts with a much smaller policy and a little younger, what it looks like for them to do policy loans soon. Okay.
So, because I was thinking, like, this is like a lump sum, and I've done it for somebody who was, it wasn't 400,000, it was 87,000, right? And using this policy for one piece of the puzzle, and then I had the other policy for another piece to then be able to leverage and use for her in a real estate venture. Because again, you have to put your money somewhere while you're waiting for that real estate deal to go through.
Yep. Sarry, were you going to say something else about this example?
Yeah, I was also going to talk a little bit about the taxes. So pretty much, the growth here, of course, as this is growing, the growth of it is growing tax deferred. So we don't have to claim these, the interest and dividends you're earning here. You don't have to claim it. Now, this is a modified endowment contract. It is a MEC policy. So there would be taxes involved when taking out the money, with gains, of course. But as far as the policy is earning interest and dividends in here, it's growing tax deferred. And this beats, CDs and money market accounts, even though their interest rates are really low, especially nowadays. But also, as far as not having to claim the taxes on this, as far as the growth within the policy, that's another huge advantage, especially for a lot of real estate investors and entrepreneurs and business owners, is that their cash not only could sit somewhere and live somewhere and earn interest somewhere, but it's sitting somewhere that's growing tax deferred interest. And that's super important.
Yeah. Okay, before we go to example number 2, just going to pause here for a second, see if there's anything else that our viewers would like to see about this example, or questions, concerns, anything along those lines.
I know we got a couple people that are watching. So if you are here, put your name, say, hey, I'm here, welcome, or I don't know, something. Because it's fun to see who is watching live. And of course, hit again that thumbs up and all of that stuff. So if you're here, put a comment. I want to know you're here.
If you're watching the replay, you can still comment too. We'll see the comments later. Okay, I'm going to go ahead and share my screen and move forward with the example I prepared. Now, make sure I'm going to zoom in a little bit on this one too. Okay, so is this good? Can you see it?
Yeah.
Okay.
And again, if you're in the comments and you can't see it, you're watching, let us know. Say, hey, I can't see. Zoom in or zoom out. Yeah.
Okay. So here we have a 29-year-old that's getting started. So at the end of year one, she is 30 years old. And she's just doing $400 per month. That's what fits into the cash flow for her, what she's thinking. I want to set aside for retirement, but I don't want to lose access to it in the meantime. Because I'm only 29. I got 30 years till I'm 59 and a half. I can't put it in something that is going to lock it up with penalties if I access it. So you'll notice much smaller death benefit than the other example because in true bank on yourself style, we shrink down the death benefit to get you the best cash value that we can. And so that's what happened here. Just for illustration purposes, I threw in some loans over here. And I want to kind of talk through what happens here. So there's, $6,334 at the end of year two. And then sometime in year three, she takes out that full amount as the loan and then pays it back just 100 or less than 100. So she takes the loan out, waits a month, and then starts $100 a month for the loan repayment. And then the next year continues with $100, then isn't able to make any loan repayments for a year. And then business gets better or gets a pay raise, is able to do $150 a month, but then is ready to, say, purchase a home or buy a car, some larger expense, just as life happens. And with that continues the loan repayment. So what you would notice if you're looking at the loan balance, she took out $6,334 and only had paid back about $4,000, $4,100, and yet could take a second loan without having to repay that in full. And then it continues to pay it back over time. I took a really long time to pay it back, and I went down here when she is 50, year 21 of the policy. And here's the cash value with no loans and the death benefit with no loans. Here's the loan paid in full. And you'll notice the cash value and the death benefit are exactly the same because there was no interruption of the compounding growth of the policy. Still got the same dividends.
I'm going to move this. Can we move it like that? There we go.
Okay, there we go. So what this is like the spreadsheet, how it works, but I wanted to do a little summary here at the bottom. So here's age 50, the total contributions to that age. I just did a sum of all of these premiums up to that point when the loan's paid in full, the cash value at that age. And so here's the difference in cash value versus the contributions, $51,000 of guaranteed growth and dividends from this policy. I'll zoom up back, go up a little bit. And then I added up the loans taken. Again, this is just adding all the values above. The loan repayment, so I could see the interest paid on that loan, $7,000. So if you look at the difference in the growth and then the extra, so what she did was pay back her loans and pay the interest in cash as well. So the difference there, about $44,000, let's have it do the exact math for us, is kind of the net $43,645 of growth that she got even when you factor in the interest paid. Now, what this doesn't factor in is what else could she have done, right? If this was maybe paying off another loan, the interest saved that would have been paid to that loan that she's not paying now, right? The interest that would have been paid on a mortgage or a car loan that she's not paying now, that she, gets to save because the interest is calculated differently, things like that. That's what's not factored in here. That's just what you're seeing in the policy. So that's my example.
She probably took a loan to buy GameStop.
She could have done that. That's true. She could have. And I want to give a little teaser here. You'll notice I've got this other tab on my Excel sheet for episode 100 for our podcast/YouTube show called FIFE, Financial Independence Female Entrepreneurs. We have episode 100 that drops on Monday, and I'm going to come back to this example and talk about the number one objection that most young people have about Bank on Yourself or infinite banking or just using whole life insurance in general that I'm really excited to share with you. So we're not done with this example. I just wanted to kind of tease that a little bit. Be sure you hit subscribe and join us Monday, February, 1st or 2nd? Look for that episode 100.
Nice. Can't believe you've been doing a lot of these.
Yeah.
Well, and I want to say on this here, not the one we're talking about on 100, but on this one, she only did like 50,000, but it's a long strategy. We're not just thinking about to age 50. After age 50 and beyond is when this policy starts building up a lot of steam because of the compounding effect. Because I look year 28, she put in 4,783, and it's growing. What's the difference? 233 to 248.
Yep.
That's the power of what's happening. It's growing more than what she's putting in by a lot, and then you add year over year till retirement. This is going to be a really awesome.
Right. I only took these numbers out to age 57. And even look at this. Between age 50 and 57, the growth more than doubles because these policies get more efficient year after year. And since she's already repaid the loan, she's not paying any more interest, which, she could very well keep using this policy over and over again. That just gives you, if we look at your age 57, now the kind of arbitrage is up over 100,000, 119,000.
Yeah, and people, and this is wonderful, Amanda. Thank you so much for sharing this. This is a lot more details than the one I provided. I want to say that people always, at first, especially people like who listen to Dave Ramsey, they'll say like, why would you borrow your own money? As if it's like redundant to do that. But this right here shows that there's a specific reason why we're doing that. We're not borrowing just to pay the insurance company interest on our money. We're doing that so that we don't interrupt the growth. Had we have just used a regular savings account throughout this whole journey, we would just have the total contributions, and that's it, minus inflation, minus all the other loss of opportunity costs we could have earned had that money been saved somewhere like this. So it's just kind of interesting to note that it's necessary to borrow the money to not interrupt the growth of your money growing while you're able to use it for whatever you want, to pay down debt, to invest in different places, to invest in your business, to put as a down payment on a home, for whatever you want to do pretty much with your money.
GameStop.
Yeah, actually, I'm going to go ahead and reveal a little bit of what I'm going to talk about in Monday's episode because this is just too powerful. So I'm going to go quickly here so you don't get everything. But here's an alternative.
You got to tune in.
Yeah, I got to tune in. But here's the alternative where we're using, I gave a benefit of the doubt, some kind of financial product that's going to give you 5% every year. If you know a product like that, please let me know. With as much as interest rates are giving these days, but let's pretend
5% guaranteed.
Yeah, let's pretend you could find a savings account or a CD that would give you 5%, but also allow you to access it. And I did the exact same comparison, the exact same numbers. There's a little bit of rounding error here. But then I added the taxes in because most accounts that give you access, you have to pay the taxes on the growth every single year. And I went really conservative with a 22% tax bracket as well. Could be way, way higher, especially 20, 30 years from now. And look at this. The age 57 comparison, the difference in the total contributions, right? So all the money added in contributions and in loan, like paying yourself back, right? If you're trying to do the same thing, your balance at the end, but really your balance after tax, you make 112,000, whereas over here we are making 126,000.
A question: where are you borrowing? So this is for example, let's just say there's a turbocharged savings account somewhere that earns 5%. Where are you borrowing the money from?
You're not borrowing anything. You're doing a withdrawal because you don't have the option to borrow. You're literally taking the money out, losing the growth while it's out, but still paying yourself back because I wanted to have as apples to apples as we could get here.
Oh, okay, gotcha. That makes sense. Okay.
Yeah, thanks for asking for that clarification. Okay. But when you factor in the taxes and you see the difference there, 113 basically for rounding up compared with 127, $14,000 of difference. And if you accessed the cash more and more, right? We only took 2 loans in the bank on yourself example. We took 2 withdrawals in the alternative example. If you were doing this over and over again, like I know we do, right? We paid off student debt. We got through a rough patch in our business. We took a loan to take an international trip. We took a loan to do a down payment on a home. We're taking a loan to pay our property taxes every 6 months, right? We're keeping our money in motion. So the more you do this, the more you're going to see the difference if you're doing this kind of comparison of accessing the cash via policy loan and paying it back versus the alternative of just taking withdrawals, losing the growth, but having to pay taxes on all the growth as you go. So this is like a very rudimentary example. I think if we did what someone is actually doing, right, as much as most of our clients are using their policies, you'd see the difference just get bigger and bigger.
Yep.
Do you encourage like people who have cash value in their life insurance policies? Do you encourage them to move that money around, like to actually get that money working in different places?
As long as it makes sense. So I'm going to stop my screen share because I'm really excited to share this. Stop share. Okay. So what literally Brandon and I do every time we're thinking about, do we take a policy loan? Do we pay cash from savings? Maybe we get a 0% offer from a financing company to say buy windows or buy a car. We literally sit down and crunch the numbers on all 3 scenarios before we decide which way to go. And 9 times out of 10, we're choosing a policy loan because of the cash flow thing. So anytime you take a policy loan, you have complete control over repayment. If we're taking a 0% loan from a window financing company, like we could have done a few months ago when we were getting windows, we would have felt pressured to pay that off in like the 2-year window that we got 0% interest and pay like a big amount every single month. And that just didn't fit into our budget. So we would not get windows if we had to do it that way. And then when we ran the numbers of losing that money from our savings account temporarily, but paying ourselves back that way, for it to match kind of what we were seen with the policy in terms of the interest, right, that we were paying on the policy versus like the interest we'd lose in the savings account and all the things there, it made more sense to us to use the policy loan, especially for the time horizon we had. It was going to be 2 or 3 years that we were kind of paying ourselves back for using this money to put new windows in. Same with a big thing like a car loan. And then little things like property taxes every 6 months, that's kind of personal preference, but I love doing that because I feel like I need to be saving to pay those property taxes anyway. I don't want to necessarily do that in an escrow account where I'm going to get very little interest. I'm going to do that as within my policy. Sometimes it's actually I'm paying a policy loan back to then take another policy loan, and I save that interest temporarily. But we have a question. I haven't even read it yet. Okay. Jeff says, how does the interest you pay to the life insurance company for a policy loan have any effect on the death benefit? I love this. Okay. Who wants to take this one?
Go ahead.
Okay. Maybe I'll share my screen again. Okay. So let me go back to the Excel because I broke it down a little bit here. So here's the death benefit.
Thanks for engaging there, Jeff. Appreciate it.
Love this question. So here's a death benefit with no loans, and here's a death benefit with loans. And what you'll notice, so let's just take this year. We had $6,334, and we paid $1,100. So I'm going to let Excel do the math for us. And our loan balance before any interest would be $5,243. Now let's compare the death benefit that year with the death benefit that we'd have if we didn't take any loans. And we'll notice it's about $300 difference. Actually, let's have Excel do the math for us again. Oops, wrong way, because that's a negative number. Okay, $289. That's the interest that was charged on the loan by the life insurance company. But what is basically happening, if we looked at the loan balance would be the $6,334 minus the $1,100 plus $289, and that's showing you that the death benefit is just reduced by the loan balance. And in this particular scenario, we're having the loan interest added to the loan balance each year. So that's why you see it included there. We could absolutely just pay this $289 off in cash and not have to worry about it. And we'd only see, so it wouldn't be added to the loan balance. And then we'd see the death benefit only reduced by $5,234. But what's fun is that once the loan's paid off and you've paid the interest off as well, your death benefit with loans and without loans is equal. Actually, the year earlier it's equal because it's paid back, and continues to be equal through the rest of the policy. Did I explain that good? Any way you want to say that otherwise, guys, to clarify, or Jeff, if you need more clarification, let us know.
Well, and one of the things that you did was do it in the first couple years when there's still the cost of insurance. There is a cost that we're going to talk about.
Episode 100 coming Monday.
And you're still combating that cost of insurance. So is there a way to run the numbers if you did it, let's say the same idea, maybe 20 years in?
Not on the fly like this. I can't do that because we're using, for the people that aren't aware, we're using sophisticated software that life insurance companies provide us access to run these numbers. They're not just Excel sheet numbers. They're things that we're running in a software and then copying and pasting into Excel. So I'd have to do a whole analysis that way, which I'm happy to do, just not right on the fly.
Well, I was meaning more, I think the growth in the policy would be more than the interest, right?
Yeah.
Typically, it would. And then if you took a loan at that point, it would just be that loan minus the interest costs.
Oh yeah. Let me actually say what I just said a different way to show this. So this year we took a policy loan. We think the loan balance is around $5,523, but look how much my death benefit grew that year. $15,000 from the previous year. And then the next year, even though I have a loan outstanding, right, it's still growing by way more than the interest, right? So I'm still getting growth in my policy, both the cash value and the death benefit. But right now we're focused on the death benefit, right? What is that? 21,000 the next year. Even though I still have a loan, I'm still seeing my death benefit continue to increase. And this is net death benefit. If I had taken this loan or this person had taken this loan and passed away, right, on the last day of policy year 3, this is what her family would receive. And it's simply the death benefit with no loans, with the loan subtracted, because that gets paid first before then the balance goes to your beneficiaries. But you'll notice that it continue, the end of year 4, even though I had a loan out, right, and my policy was still growing, my family still gets this death benefit here. Is that what you're trying to look at, Brandon?
Yeah, I was just kind of looking and saying, okay, if they did that in the first or second year, there's still a little bit of getting that plane off the runway, if you will, costs, that kind of thing, which people always argue that cost there is, but yet the long range, thinking both long-term, short-term, and how you're going to grow your money at the same time. We're kind of looking at it from all different lenses, or trying to.
Yep.
Yeah, it's not necessarily like an either or approach. It's not either we do whole life or we do other places. It's kind of an integration, right, of all of the above, for us to kind of have like a parking garage for our money. So it has to live somewhere, it has to sit somewhere, but also it could leave the garage and go travel, take advantage of opportunities, invest, do whatever you want to do with it, pay for the vacations, but it comes back to the garage at the end of the day.
Yeah. Sarry, can I turn your question to us back on you?
Yeah.
Like, how often, like, when do you decide it's right to take a policy loan, and when do you just, say, I'm going to do something different?
Yeah, definitely. I think I would do the math like you guys do. Like, I would compare all three, whether it's you're paying cash for it, you're going to borrow from somebody else to pay for it, or you're going to borrow from the policy, and then pretty much use that loan calculator we use to see how much you would pay interest over time, and then to kind of compare it to the current illustration that's in force, the growth of the numbers. And then if the growth of the numbers outweighs the cost, then I'll choose the whole life policy, and then to take the loan from there.
Yeah, I guess we should probably say that we definitely talk to people a lot about you're going to still live your life similar, right? If you would normally buy a Toyota or a Chevy, you're not going to go buy a Lamborghini just because you're using a policy loan, right? Yeah. Like, this isn't a license to be a spendthrift. You still want to be responsible financially and do the same thing you'd probably do anyway, but in a smarter way.
I agree.
Cool. Yep. What else did you add, Brandon?
Can you hear me? There we go. I'm trying to share it on my other page as we and the problem was I ran from one meeting to the other, so I didn't get to do all the Facebook stuff. I think the thing is, what I liked is we were sharing multiple examples. People are different. And when somebody asks me, well, what should I do? And they just want me to run an illustration, I want to know more information. Like, you have a windfall of a business coming through? Like, that's a different conversation, and how you might leverage the money in one way, or the other way of, hey, I need to save for my future in retirement. And so that's one aspect too. And so really what I'm hoping that we were able to do here was share, you finance everything you buy, and how to leverage the policy and not lose the growth or lose the risk and all that stuff. But the risk is taken off of you.
Yeah. Sarry, I know you love running the numbers for people, helping them make the right decision for themselves. If people want to chat with you, how do they get in touch?
Yes, so they can go to our website. It's finassetprotection.com, FIN assetprotection.com, and they can just schedule an appointment with us through that link.
Great.
Yeah, thank you
Put
guys.
that in the chat there.
What's that?
You put that in the chat there?
I'm working on it.
I think.
There we go.
There we go. Is that right?
Thank you. Yeah, thank you.
Yeah. I need to post it on Facebook too.
And then of course, you guys anybody can reach out to us at grandmaswealthwisdom.com and schedule there. Or if you want to reach out, send us a message, send us a chat. We try and get to everything as we can.
Yeah. And if you like this video, you like this idea of us going live, kind of answering some frequently asked questions, talking about how policies work, that kind of thing, please let us know. We're thinking about doing this more regularly. And let us know if you want us to do that. And then also let us know what you'd like us to talk about. Maybe there's some burning question, or there's a question that you had that you're like, you guys addressed that really well on the phone or on a Zoom call with me, but I think more people should know about it. That's helpful to hear too, because we often don't realize what actually like helped it click for people. Yeah,
I had one client actually say, "Hey, this video of that somebody else did really helped me," and it was as a bank on yourself advisor, and I was like, "Awesome, that's great." And he's like, "You guys should do a video like that." So we did. And he's like, that was really, really good video. And if you want to watch that video, you go to our playlist. Bank on Yourself FAQs is the playlist. And the title of that video is the dollar diagram one. What was that one, Amanda? Do you remember?
Why would you pay interest on your own money?
Yeah. Why would you pay interest on your own money? That was a really great video. On again, why would you pay interest on your own money? And we kind of touched on that here. Amanda goes into some great detail there as well. So,
okay. Any concluding thoughts, Sarry?
No, I think you guys did a wonderful job. It makes sense. Thank you. It definitely makes sense as to how the loans work, and it's nice to see. It's nice to see this in motion, right? Instead of just all theory. And kind of like this infinite banking concept or bank on yourself concept, but actually in practice, like actually with the numbers illustrated and shown, especially when we're showing guaranteed growth as well during this whole thing, and not like projected or GameStop numbers.
Yeah.
I thought I was going to be the only one that brought up GameStop. I don't know.
Hey, I was in this chat earlier and they were talking about Bitcoin. As much as people are focused on GameStop right now, we've seen the same kind of thing happening with Bitcoin too, where it'll get driven up really high and then all of a sudden crash. And this is kind of in the technological world we live in now. The roller coaster of things like the stock market or, whatever are just going to accelerate, and the ups are going to get higher and the downs are going to get lower, possibly because that's what technology does, right? It makes everything more slippery and easier. I wonder if that's what's going to happen with money as well.
Yeah, definitely. Sorry, go ahead.
Oh, and I was going to say in some of this, I think it's we need to build stability in our own financial lives. And this is not going to compare with the highs and lows of GameStop, right? It's not going to do that. But I also know, and what I'm thinking about with some of that, why certain platforms froze things is because if people lose a lot of money, all of a sudden, it could drive people to bad places. And I don't want that to happen. None of our clients cannot lose any money from this. So anyway, thanks guys for being here.
Oh wait, Sarry, did you have something to add?
No, that was wonderful. And I think, as you mentioned already, the technology part of it, it definitely it's going to make, I think it's going to make money more capable of being manipulated more in the future than it is now. And I think that's one problem for a lot of investing like passively into these new places like cryptocurrency and the stock market and different places like that. It could be more of a trap for the later years, definitely. So that's something that people need to like kind of watch out for.
Yep. Absolutely.
And I am all for, if you understand these things, use the cash value, but really understand what you're getting into. Like, understand, don't be just what do they call it, armchair investor, but really know what you're doing. Like, as a business owner, you use your cash and your brains really to grow your wealth, and knowing what you're doing and being a specialist, I think that's the power.
Yeah. So if you're just joining us, please go back, watch the full episode that we just recorded. Sarry shared a really great example of a real estate investor and how they leverage their cash value to take a policy loan and continue their real estate investing journey. I shared an example of an average 29-year-old and what she has done with her policy recently.
Can we let the cat out of the bag, that average example?
Yeah, so it was based on my original illustration. It's not everything I've done with my policy, but a couple examples there. There you go. There's the cat out of the bag, if you couldn't figure that out already. Okay, I think we're ready to sign off. Thanks for joining us. Be sure to subscribe. Guys. Reach out to Sarry. Thank you, Sarry. We look forward to the next time we get to do this again.
Thank you. Appreciate it.